So, wages and payroll, I don't know, we're going to say we're a small shop. Again, I'm just making up numbers here. I have not done any math to see what it would staff the shop and hours and things of that. You would have to do that, ahead of time to have an idea for what you think the wages and payroll would be. But we'll start off with what we think the startup month for wages and payroll would be. Let's just say it's $5,000. Advertising and marketing, we're going to spend another $5,000 because we're a small business here. Web hosting, we're going to spend, you know what, we're going to pay for the whole year in advance. We're going to spend, I don't know, $100 or whatever it is to web host. Rent, sometimes, you have a deposit as well as your first month's rent. So let's say we got a small location. We're going to do $5,000 for the first month. We're going to do $2,500 a month rent, but we'll do $5,000 for the first month. Utilities, again, making up numbers here. 500. Accounting, say we have to pay an accountant to set us up with QuickBooks or something here. 500. Equipment, rentals. Now, this is an area where, in this situation, if I have a coffee shop, I have an option of either renting the equipment or there's another area where I'll be purchasing the equipment. For this example, I'm going to use purchasing equipment because I'm going to use a loan to purchase it, and I want to show how to enter in the loan information as well. So for equipment rentals, I'm going to leave it blank unless I can think of something else that we need, but I'll leave it blank for now. Internet, telephone, there's going to be some installation for it. Commercial installation, I'm going to put $500 for the first month. Travel and entertainment, nope, not doing anything. Insurance, I don't know. I'm just going to make up a number. Perhaps workers' comp or whatever other insurance that is required for commercial business. Licenses and permits. Again, making up a number. That will be dependent upon your local municipality and or state. Pest control, you may or may not have this, depending on the type of business. Security, most businesses will have. Let's say you have a commercial installation for security. Landscaping, I'm gonna leave that blank. We're in a commercial building. We're renting from somebody. We'll let them do the landscaping. All right, so we have our startup month for our expenses. And again, if you have others, you can simply enter them in here. For the purposes of this example, I'm just going to use some of the most basic expenses that we do have. To your startup month expenses. Now, keep in mind, if you do have other startup month expenses that do not fall within the categories that are already listed here, you do have these other spaces where you can enter in other startup expenses. You can enter that in, and then what you would simply do is just enter in the amount here next to them. So now that you have your startup expenses entered in, the next thing that you want to do is we want to enter in our monthly expenses. So these are going to be, with the exception of the first month, what our expenses will be for each month thereafter. Now, you'll notice that in this particular area that there's two options. One, there is a monthly option, and then for the other, there is a percentage of income option. Now, there's a reason why that is there. Now, with our expenses can be, they can come out two ways, if you will. There are some of our expenses that we know will stay the same each month. We don't expect them to change each month. However, there are other expenses that, depending on the nature of our business, may fluctuate from time to time. For example, let's just say with the cafe that I have here that I decide to host a special event. And because of that special event, I'm expecting more people to come through the cafe, more people than that would normally come through. And as a result, I am going to put more staff on. And so for that particular month, my wages, or that particular week, my wages may be more than what they would be because I have another event where I require additional help. So you'll notice here, I have the wages as a percentage of income. That way, if my income goes up, I'll account for the fact that I may have to put more people on. And if it goes down, then it accounts for the fact that I'll be, you know, scaling back on hours. Now, for the rest of them, we'll go through and we'll just enter them monthly, or we'll enter it as a percentage. I'll just go through line by line and enter them in. And that'll get us to our total monthly expenses. That is after the startup month. So we'll start with advertising. Let's see, we'll spend 2,500. Web hosting. Even though we pay for the year, we'll still set aside some for next year. Rent, 2,500. Again, I have no clue. I am just making up numbers to plug in to show you how things work. Our utilities, leave it at 500. Not 50, 500. No equipment or rental. Internet, telephone, we had installation at first. It'll come down, so we'll do 250. Insurance, no clue, but let's just keep it at 1,000. License and permits. Let's just set aside a little bit in case we have to renew some licenses and things. Pest control, we'll keep that at 100 monthly. Security alarm, we had installation, so that'll come down monthly. All right, and then we won't do anything for landscaping. So the rest of them I'll do as a straight monthly, and the one that I did as a percentage is the wages. Now keep in mind, you can do one or the other. You cannot do both. You cannot enter a monthly and a percentage. There's a little note up here to remind you of that. But if you choose a monthly expense, you cannot choose a percentage of income. It is either one or the other. All right. So when we're done, what you'll have is a total for your monthly startup costs, and then a total for your monthly costs. And then over here, you have your total income. So what we'll do is we will continue moving on down the line to the next section of the spreadsheet. To your startup. And so for the next section of the spreadsheet, we have our startup costs. Now, these are things that may be one-time costs that are required for you to get your business off the ground. For example, I own a cafe that we're going to be selling coffee. I may have to purchase an espresso machine. There may be other, coffee equipment, there's furniture and things like that I'll have to purchase. I'll need a starting inventory, so I'll have to purchase a bunch of things just to kind of have a starting inventory. So this is the area where you plug in all of that information. So for starting inventory, I'll just put $2,500 worth of coffee beans and other stuff. Land, I didn't purchase any land for this one. We're going to be renting, so I'm going to leave that blank. Building and improvements, that would be if you're building on land, like, if you're building a building. We didn't do any of that, so I'm going to leave that blank. Machinery and equipment, we will need some machinery. We will need some espresso machines and coffee grinders and things of that nature. So I'm going to put a $10,000 budget for equipment. Again, just making up numbers. Furniture and fixtures. We'll go another $7,500 for furniture and fixtures. Signage. $2,500 for signage. We won't have any automobiles. Now there is space for other. You won't be able to change these here, but if you do have any other startup costs, you can just simply put them under here, other, and it'll factor in those startup costs. From there, we will move on. Now, for this point on, I'm going to move on just strictly down the left side, and then I'll come back over to the right side, and I'll go over the loans and everything that is on the right side. So we're going to move right on down the left side here. This part right here is for existing businesses. So if your startup business, there won't be anything for you to enter here. If you are an existing business, then you will enter in information if you have existing assets such as land, building, machinery, furniture, and fixtures. There's only one area that the startup businesses will use, and I'll get to that in just a second. It's the cash on hand, but we're gonna come back to that. But anyhow, say you were an existing business and you did happen to have some land that still had value in it. You would put, let's say it's worth 10,000. Again, just making up numbers. You'll put that there, and let's say it's got, I don't know, 7 years of depreciation left on it. You'll put that there as well. Now, I'm glad I did that. Points out one important thing with the assets. You'll notice that some red popped up on the screen here when I enter that in. You'll also notice that there's a little message right here letting you know that the total assets and total equity/liabilities must be the same amount. Adjust the stockholders' equity or value of current assets to make them equal. Here's what that's saying. That's basically saying that if a business is owned, or if you own $10,000 worth of land, that land has value, someone must have equity in it. And so to balance that out, we must also put the $10,000 here. And you'll notice a message in the red disappear. Now, that goes for everything that you put in here. If I were to put another $1,000 here, just to show you, for example, you'll notice a red message pop back up. That's because now my total assets that I currently own are $11,000. However, I am only showing that I have $10,000 worth of equity in the business, and we'll want to change that to $11,000, and then those things will balance out. So again, that is for current existing businesses. If you do have existing assets, you want to enter the information here, and then you want to enter an equal amount here in stockholders' equity, just to account for the value that is owned in those assets. Okay, but we're a startup business, so I'm going to zero this out, and I'm going to zero this out. I'm going to zero this out as well. Now, you notice that's still red because I got to go here and I got to make the zero so that they equal each other, and then all the red messages will disappear. All right, so moving right along, again, for current or existing businesses, if you have accumulated depreciation, you'll put the dollar amount, the year, amount and value here, and it'll total up the assets for you here. You don't have to do any math, so this is one of the areas where you don't want to touch anything because it'll do the math for you, okay? Now, going back up, I mentioned cash on hand. As a startup business, we will use this part of it, but we're going to come back to it. We're going to come back to this after we enter in the loan information. The reason that we're going to do that is because in a few moments here, we're going to enter in a loan amount. We're going to enter in the loan amount to cover enough for our startup costs in our startup month, as well as to leave us some operating cash to operate with. So we're going to enter that dollar amount in. Typically, when you take out a loan amount, you pay out those lump sums in the first month to cover your startup expenses, and then you have your operating capital on hand afterwards, which will be your cash on hand. And so we're going to come back to this in just a few moments once we enter in a loan amount, and then we'll put the cash on hand. All right, so moving right along, stockholders' equity, like I said, you'll only enter anything there if you have existing assets there. Otherwise, if you do, you'll get that red error message. For other liabilities, if you do have other things that you simply owe a balance on, you can put the dollar amount, the amount of years owed here, and then the interest rate that is on there, and it'll calculate the total. It'll do the calculation for your total equity and liabilities for existing business. All right. Now, everybody's got payroll tax. I'm be honest with you, I have no clue what the percentages are for payroll tax. So if these numbers seem way off whack, I'm just plugging in numbers so we have something here. But you do have an area for payroll tax, income tax, as well as interest earned on your cash on hand. So we'll start off by just entering in the payroll tax. I am making up per percentage. We'll do 8%. Income tax, 8%. Let's say, we'll do higher payroll tax. They're going to take a lot out of your payroll. Now, interest earned is just for the cash on hand that you have sitting for your operating. If you are earning an interest rate on that, you'll put that there. Or if you happen to have some of your cash held in other things that do earn you money, you can put the interest rate there, and it'll factor in you earning an interest rate on an annual basis. And it'll factor that into your cash flow. So what we have here is a total startup cost of $41,700. Now that startup cost, that factors in any of our equipment that we needed to purchase. That also factors in any of our expenses for our startup month. So that'll give us our startup costs, but we're not entirely finished. We have a few more sections to fill out, and then we'll be done with the start page. All right, so our next section is our loan section. So over here on the right, we're gonna go to our loan section. There's 4 sections to enter in loans, so you can enter in up to 4 loans. You start with entering the loan amount. Now we had about 47,000 with this startup down at the bottom. So I'm trying to do 100,000. I'm going to do a $75,000 loan just to see how it plays out. $75,000 loan. You will enter the interest percentage here. You don't have to type the percentages also anywhere on the sheet that you see percentage. You can just enter the number. It's already formatted for a percentage. So you enter the interest rate. I have no idea what loans are going for businesses right now. And we'll do the term, 7 years. And you'll see that it'll give a monthly payment amount for a loan of $1,095.64. If you have more than one loan, you can simply go into loan 2, 3, 4, and enter in the loan amount, the interest, how many years the loan is, and it will calculate the monthly payment for you. And that will factor into your income cash flow as well. All right, so now we'll move into the final portion of the sheet, which is our break-even analysis. Now, this particular part of the start page is not tied in directly to the other aspects of it, so the other income, so you have to enter it in a little bit manually. But what it does is it helps create a break-even analysis for your products, as well as just for your overall company. And that part you'll see on the dashboard. So, for example, let's say on average, our average cup of coffee is going for $2. We'll put that in. I think we had a 10% annual increase up there, so we'll anticipate that. Now, here's where this becomes useful. You do in this particular area. It more or less it helps you kind of, and you'll see this on the dashboard. It'll help you more or less see what particular products are performing or outperforming others. What particular products are leading the business, if you will. And so it's a little bit, like I said, it's separate from the other information. But if you take a moment to enter it in, it's really helpful information on the dashboard as well. So let's say our average bakery is, I don't know, bakery sometimes can be expensive, $6. And I think we said we were going to see like a 15% increase on that. And we're going to see 20% increase on the specialty. And let's say our specialty drinks are about $5 on average each. All right. So with that entered in, we are officially done entering everything that we need to enter in on the start page. Now, in an ideal world, we would be done entering in our projections altogether. However, we do know that businesses have ups and downs, ebbs and flows. And so in some instances, it may be necessary for you to go in and make changes because of that. As a result, you can go in and do so. In the next part of the tutorial, we're going to dive into the dashboard. We'll also dive into the income statement, the cash flow summary, as well as the balance sheet. We'll show you what that looks like and how you can make adjustments to account for the ups and downs of the business. Okay, so we've entered everything that we need to enter in on the start sheet. And in an ideal world, we'd be done with our business projections, and all we need to do is print them out and have nice, neat business projections. However, we know that starting a business is often less than ideal, and so there's a couple of things that we need to take in consideration. The first being, if you take a look here, remember earlier I mentioned that we put in an annual growth. You'll see the 10, 15, and 20% annual growth for our products here. I explained earlier that how the spreadsheet calculate those is it makes some gradual growth. And so what happens is over the course of a year, you see your business monthly grow until at the end of the year, you'll have a 10% or a 15 or a 20% growth. However, In most businesses, there are ups and downs, ebbs and flows. Some businesses have seasonal periods where their business is a little bit busier than others. And so, in just a few moments here, I will show you where we can go in and we can actually edit those things to account for seasonal changes. And then the other thing that we have to take in consideration is that we don't know what this looks like now. We don't know if our business is profitable, if it has a break even or not. I can tell you right now, it doesn't look so good because we got 19,000 in monthly expenses and only 11,000 in total income. But we want to kind of know what that looks like. When do we run out of business, et cetera? And that is where the dashboard comes into play. So if we click here on our dashboard, right, there's a couple of things that you'll notice here on the dashboard. The first thing that you'll see, there's a menu across the top that lets you get back to the main menu or the start page should you need to. There's a chart here. The chart is an interactive chart. You can click on the year and it'll provide you a year, drop down for any of the years. So if you want to go, let's just say from year, acting a little weird. If you want to go from year 1 to year 2, probably not much of a change because we're losing money on each of those businesses. So you can do that. You'll notice that the numbers change over here as well. It's a slight change in the charts, so I'll go over really quick what's in the dashboard, how that helps you in terms of what changes that you need to make to your business plan if the business is profitable or if it's losing money. So the first thing that you'll see over here is you got your income and expenses and whether or not there's a profit for year 1. We're losing 199,000 for year 1. Gives you your profit margin, your cost of goods, your loan balance at the end of the year, your cash balance at the end of the year when negative. There's some other information that you'll find along the side of here. As you scroll down, you'll notice that there's an education and resources section. That section is just links to our website, and on the website you can find information and articles about certain topics that go into creating financial spreadsheets. So, for example, you'll see what is an income statement, what is a balance statement, what is a cash flow statement, and just other things that are general knowledge. But what I really want to dive into is the breakdown and how you can actually use the dashboard to help you make changes. So what we'll do is we'll scroll down just a little bit further here. All right, and as we scroll down, you'll notice that there's a yearly summary for years 1 through 5, and there's a 5-year summary that gives you kind of a breakdown on what's going on with the business. And there's a few things that I'll kind of go over line by line that are included in each of the year summary. So the very first thing that you have is the income from the year. You have your expenses for the year, whether or not there's a profit or loss. You have your average daily income. You have what you actually need to break even daily, and then what that difference is so you know how much you're coming up short. You have your average daily number of sales, how many sales that you need to break even, and then how many that you're short of that as well. It gives your ending cash balance as well as your loan balance. Now, how do we come up with things like the average break even or daily number? So for example, the average number of products that you need to sell daily or that you are selling daily versus the number that you need to sell daily. I'll show you where that is, or an important part of that, I should say. Remember here where we enter in the average sales price of each of our products and the increases for each. Well, that helps factor in on average, what our average product would sell for and the average number of daily sales. So going back to the dashboard and then scrolling down, you can just see on a yearly basis that we're showing a loss. But the most important thing I want to show you is a little bit further down here. So we'll go here. This is our break-even chart. You'll notice that these two lines on the chart do not cross each other, which means that we do not show that we break even within the first 5 years of business. We're showing a loss for all 5 years of business as of right now. So there'll be some changes that we need to make on the startup page. All right, so this is the area that I wanted to show you. This is a summary. This is my favorite area of the dashboard. It's broken down into 4 areas. It's profitability, break even, cash flow, and cash reserves. For the profitability, there's an NA here because we haven't reached profitability. But as we fill in more information, you'll notice as we make changes on to the start sheet, there'll be information that fills in here that gives you a little bit of insight of what's going on with your profitability. Break even, same thing I mentioned earlier. We do not break even, so your company breaks even, and it's just NA. It's not applicable because we don't break even. Now, the cash flow, you can see some information here in regards to the cash flow. It says your company falls below 12-month reserves by January 1st, which is basically the day that we start business. We don't have 12 months worth of cash flow, and it also lets us know that we don't have 6 months worth of reserves starting day one as well. Now, how that's calculated is it takes a look at what your monthly expenses are and takes a look at what you have for a cash balance, and it just essentially does the math to determine whether or not you have enough cash to cover your monthly expenses for 12 months or 6 months should you not take in any business whatsoever. So that's just designed to help you should your investors, lenders, or bank want you to have a minimum amount of reserves. You can use this to help you decide whether or not you have 12 months, 6 months worth of reserves in there. So we go over here to cash reserves. Your company runs out of cash by June 30. So essentially, we run out of cash about 5 months after the business launches. And then it gives us just a couple of things that we could do to change that. So, for example, consider the following to increase your cash balance, increase your starting amount of your loan, increase your owner's starting investment amount, or increase your monthly revenue, or increase your monthly revenue growth. So it just gives us a few options for what we can do to change so that we can show that the business is profitable.